Welcome to The Accountant Quits, brought to you by Harris and Trotter Digital Assets, a UK-based firm specializing in accounting, tax, audit, and advisory services for digital assets, serving clients worldwide. With a clientele of close to 600 crypto-native projects, Harris and Trotter is now offering a scholarship and job guarantee to students of the Crypto Accounting Academy, and you can learn more at theaccountantquits.com/scholarships, or keep listening to this episode where I share who is eligible and how to apply. And the Web3 Finance Club, a community of Web3 CFOs sharing best practices on Web3 operations. On this podcast, we discuss how blockchain will impact the accounting profession and how accountants should prepare themselves for the future of work. My name is Umar, your host, and even if some might refer to me as the accountant gone rogue, my job is to provide you with the blockchain knowledge you need that will be relevant for the accounting industry as a whole. Welcome to episode 71. When it comes to internal controls, management is responsible for designing, implementing, and maintaining effective internal controls. Auditors, on the other hand, would test for the operating effectiveness of these controls. Many auditors today lack the specialized expertise needed to provide assurance for companies holding digital assets. But if we are rooting for cryptocurrencies to become mainstream, auditors will have to quickly come to grips with how to provide assurance for digital assets. Blockchain has the potential to allow auditors to have absolute assurance over on-chain transactions, which is an enormous leap forward from the limiting sample-based approach currently used. To help us understand the knowledge gap, today I have the pleasure to be speaking with David Byrd, a partner and the blockchain strategy leader at EY US. EY US have audited public companies like Robinhood, Bakkt, Block, and have partnered with L2s like Polygon to offer blockchain services including EY Opschain and EY Blockchain Analyzer. In this episode today, you will learn the challenges specific to auditing digital assets, how auditors prove ownership for centralized versus self-custody, tests of controls for digital assets, the relevance of SOC reports from exchanges and subledgers, and much more. David, welcome and thanks for taking the time to be here.
I really appreciate you having me on. It's a pleasure, and I can't wait to get into the discussion.
So to start, can you share a bit more about your background, how you became interested with blockchain, and the story of how you started servicing your first clients who had digital assets at Ernst & Young?
Oh, sure. Yeah. I love to recount the origin story for the space. Yeah. I came up in EY through our audit practice based here in San Francisco. And in the early days, some of our earliest clients in this were asset managers. This was quite a while ago. And, in the beginning, it was pretty simple relative to what we see today. In the beginning, it was largely just sitting on a hill, a mountain, perhaps, of Bitcoin. And so then thinking about, okay, from an audit perspective, what do we need to do to obtain that sufficient appropriate audit evidence, for this financial statement audit of the client. And then over the years, as the space grew, we noticed that there were more and more enterprises getting into this, not just investment managers, but also exchanges, mining companies, you name it, both in the what we would now say today as crypto native, but also in the sort of more traditional spaces and markets getting into space. So it's been a great journey. It's not been me alone. I've been surrounded by some terrific talent and now have a great team surrounding me, not just in the US, but trying to stay coordinated globally, because you often hear it said, right, that blockchains, sort of like the internet, don't necessarily respect geographic boundaries. Like, it's around the world. If you do want to serve enterprises, audit, tax, you name it, in this space, it really is a global phenomenon. It's been good to stay connected with all those too.
Perfect. Thanks for sharing, David. I'd like to start the conversation with client acceptance and the challenges specific to digital assets. So, when accepting a new client, auditors have a client acceptance process to ensure they have the adequate knowledge and experience with digital assets. Now, digital assets, it is a novel asset class. And I mentioned in the intro, it's a small subset of auditors today that have this in-house specialized knowledge to audit digital assets. So let's say there's an auditor listening, contemplating to expand their services for digital assets. What would you say are the main challenges specific to digital assets?
Got it. Yeah. Well, specific with the sort of client onboarding. Yeah. I would say that there's a couple things that may be worth calling out. One is that from a firm perspective, and I think this is the case in many other audit firms out there, we have a general client acceptance process to go through, right? Where you're checking to understand who runs this company or organization, what does it do? Is it compliant with laws and regulations where relevant, all that sort of stuff. And so you asked for what's specific to digital asset companies and activities in this space. But I would say something that has been specific to this area is that often the startups in this space, they struggle with just some of the usual stuff, right? The challenge is that, especially if you're a digital asset company and you suddenly find yourself in control of what is effectively customer deposits, then the bar for controls around that and compliance specific to that is significant. It can sometimes appear like the level of a bank that have worked on these topics for many years. So when trying to onboard a new client in this space, certainly if they are in possession of customer assets, that bar could be tough to clear. Just the usual bar of all the boxes you need to check. But a number of them do it quite well. Now, when you think about, okay, well, but we're not talking about just any company, we're talking about digital asset companies. Yeah, because of the nature of this, like you were saying, what asset class, this domain, this novel tech stack, because so much of it is public networks, public blockchains, these are not tech stacks that are run by a single company or legal entity somewhere that you can just check with quickly. They're very different. It's, the internet, which is this sort of public good, right? So there are nuanced considerations that I think every firm needs to think about when onboarding a client whose business operations, processes, financial reporting is a function, sometimes directly of this public infrastructure. So we can get into it in more detail, and I probably pause here to take a breath. But really, that I think is kind of the core of some of the nuance is how can companies and auditors in their role rely on data from these public networks?
All right, thanks for sharing. So I'll go a little bit more into detail on the different assertions that auditors would typically need to get assurance on completeness and ownership in a bit. But okay, we can start with ownership. First, I'd like to go on the case of centralized custody versus self custody. So, in the case of centralized custody, David, typically with bank balances, auditors would send independent bank confirmation letters to that company's banks. They would reconcile the confirmation received against the reported amounts in the balance sheet. One could expect a similar procedure when a client, let's say, they're using a third party exchange or a custodian to store their digital assets. But from previous conversations I've been having with auditors, I understand this is not a widely, let's say, accepted practice right now to send confirmation letters to such digital assets exchanges or custodians, similar to what we have with cash balances held at banks. So I'd like to understand, so how would auditors typically prove ownership of the digital assets when these are held with these third-party custodians, exchanges, and whatnot?
I'm so glad you led with this question, or at least early in the discussion, just because custody for this domain, as I know you know, for digital assets, crypto, Web3, and all the rest, it's all about custody. Who holds these things? And the fact that, like you were sort of distinguishing, not everything is sitting at some centralized custodian somewhere. That's one of the virtues of Web3, right? Is that ownership can be held not just by traditional intermediaries. The companies themselves can hold them. So I would say that certainly initially there was not as frequent or recognizable confirmation of both existence and rights and obligations or sort of control of these assets just by sending a confirm to someone. Because, of course, being so new, being at the frontier of financial technology, there just weren't such entities, or there weren't entities that really checked the usual boxes that you'd see. You mentioned sending a cash confirm to the bank, right? Confirm your client from that audit perspective has what they report their financials. Yeah. So in the beginning, there just weren't any of those. But now there are quite a few that are out there and quite a few that have started checking right all those boxes. I've been saying this for a few years, but now it's, so for instance, there are institutional digital asset custodians that will, from a sort of regulatory or compliance perspective, look to make sure they're checking the boxes, like I was saying, of either a qualified custodian and things like that. They will themselves have an auditor, right? And most importantly, for the audit of a company whose assets are held at a custodian, they will have a SOC 1 Type 2 or equivalent report, right? And you had mentioned before that so much of this discussion is around controls and internal controls, and that's what that SOC looks at. There are happily now much more traditional procedures that can be done if you're a company that's holding assets at these third-party custodians. But the challenge, even if they exist, and maybe this is what you're getting to, you just let me know, is that in this space, these are assets that, depending on your business model, won't just sit under a mountain somewhere. You put them to work. You do things with them. You stake them, right? You participate in all sorts of decentralized applications. It's tough for a business to keep all of our assets at a third-party custodian if they want to do things with them. Now, a lot of custodians have started to accommodate those better, right? Oh, we can stake it for you, or we can help you participate in governance, or we can do this, that, or the other thing. But on all the blockchains and on all the assets you want, it's tough. So right now we do see from that audit perspective a blend, a blend from both the sort of use of assets at custodians, but then also self-custody to enable those other challenges.
Got it. Speaking about self-custody, businesses today, they would typically use multi-signature wallets like a safe or MPC wallets like a Firebox, as opposed to individuals who would use like a single key signature wallet like a MetaMask, right, to control the movement of their funds. So I understand auditors would need to obtain an understanding of the different safeguards that company has put in place for the storage, for transaction initiation, authorization with those multi-sigs or MPC wallets. So let's start with storage and security of the physical location of those private keys. I want to ask you, from what you've observed, like during the audits, what are some good practices around storage of the private keys?
Sure. And do you mean, I'll just ask a clarifying question, sort of good practices that management or the company, that is the audit client, can do around that, or good practices on the audit side? There are both, but I'm thinking you're probably thinking the former.
Yeah, that's right.
Yeah. There are lots, and it depends on, like you were just describing, well, what type of wallet are we looking at here? What type of, custody solution or self-custody solution do auditors often see at clients, and what do we regard as best practices? Well, so first with the types, you listed a multi-sig circumstance or like a multi-party computation, an MPC circumstance. Yeah, those are absolutely safeguards that we witness clients, or really anyone, ought to have in place around this because of the bare nature of digital assets. That is, once they are no longer within your control, once they're in someone else's wallet, there's no sort of higher authority you can appeal to get them back, right? So that just makes the controls around safeguarding of these assets even more important. And multi-signature or MPC or other things that require several people or entities to sign off before a movement can occur or some sort of activity. These are examples of prevent controls, right? So that is, in the universe of internal controls or just controls in general, you could say, well, there's controls that prevent things that you do not want happening from happening. And then there's the detect controls, right? Like detecting that, oh, wow, something just happened that we did not want, right? So these sort of wallets and the safeguards around them are examples of prevent controls, right? What's going to stop someone from getting access to these that shouldn't be. I would say a poor practice, just to define a contrast, is, what we'd see years and years ago, where there was one person at the client and they set up the custody solution, the wallet, and it only required them to transact or move or safeguard these over time. That's obviously a total absence of real prevent controls, right? So I would say that's what auditors see. I'm trying to think if there's any sort of more detailed best practices around the safeguarding of the private keys or related cryptographic information for digital assets. I'd say, as far as best practices go, documenting these controls. We find clients in this space to be very security oriented. Sometimes nuclear secret grade securities have been put in place. But what we don't always see is having people that work in the financial reporting part of the company understand what those controls are, have documented them, and then, of course, have this regime that you had talked about at the beginning around the testing of these controls. Have they been designed appropriately, right? Are they operating effectively over the period in question and continued, right? That's often a challenge. So I would say another best practice is not only having had the controls in place, well, it's come in 1,000 forms. So there's not one specific set of controls that everyone has to have. After all, their business models vary. Maybe you need access to these more regularly. Maybe you don't. And your control environment can look differently. So whatever the environment, hopefully you've been thoughtful about what the relevant controls are, you've documented them, and you've got this sort of like design and testing regime.
Before we continue, we'll take a quick commercial break from our sponsor. If you're like me and have clocked some serious hours at a Big Four, BDO, or other big name accounting firm, you know the drill. Rigorous training and a rock solid work methodology. But here's the thing, while a lot of these firms speak about blockchain, in practice, just a handful get the nuts and bolts of accounting and auditing for digital assets. One of those firms is Harrison Trotter. Since 2017, Harrison Trotter has been growing into a well-respected leader in the Web3 space. Currently, Harrison Trotter offers audit, accounting, tax, and advisory services to close to 600 crypto-native projects. And here's something cool. Every single of their digital assets partner is under 35, with some making partner status in as little as 12 months. Their drive, fueled by the vision of their CEO Nicholas Newman, knows no limits. And Nicholas has personally reached out to me with an incredible offer for the students of our Crypto Accounting Academy. He's offering scholarships and a guaranteed job placement with Harrison Trotter. Yes, you heard that right. So how do you get in on this? First off, you need to be based in the UK because you'll be joining their team at their London headquarters. Plus, you should be enrolled in either one of the ACCA, ICAW, CIMA, or SICA programs. And of course, you need to have a genuine interest in crypto and the wider Web3 ecosystem. To enroll in the program, you will be required to complete the 7-week Crypto Accounting Academy, and upon completion, you will start your journey with the Harrison Trotter Digital Assets team in London. Are you ready to apply? Head over to theaccountantquits.com/scholarships, fill out the application form, and I'll personally be in touch. All right, so next I'd like to touch on tests of controls. So in some cases, substantive procedures alone may not provide sufficient audit evidence, and auditors would have to test for the operating effectiveness of controls. We've just touched on safeguarding. I'd like the listeners to also understand the different controls they can put in place to extract transactions from the blockchain. Now, there are different ways for a company to do that. The first one, they can host their own node, so they can have the in-house infrastructure to obtain information directly from the blockchain. But of course, most companies won't do this. This is logistically and financially not viable. They can use block explorers, of course. They can use tools like subledgers. Now, not all block explorers are built alike, right? And the reliability of the blockchain itself can pose some additional risks. I want to ask you if you can walk us through how an auditor would generally test for completeness and accuracy of data
Mhm.
from like these blockchains. Would you guys at EY be hosting your own nodes, let's say?
Blockchains, absolutely. And you've packed a lot into the question and prompt there, really important considerations. And, partly around controls reliance versus substantive testing. You've also got in there how auditors obtain information from the blockchains to develop smart contracts for their clients' activity. How do you know that's complete and accurate, right? What are examples of that source of information? Is it running your own node? Is it relying on a third party to run that node? Is it these block explorers that we've seen, right, that are out there? Really good stuff. And I'll first have a shout out to just a great industry publication that continues to get better, which I was just looking at again this morning, which is the AICPA's practice aid. Well, specifically, I believe they call it the Accounting for Auditing of Digital Asset Practice Aid. So that's great because what the ACP has done as an industry group got together and spoken to accountants and auditors, at a number of the firms and just tried to compile what these are. They've got a whole section on considerations from an audit perspective if you're relying on block explorers, right? It's just wonderful to see because often you only get that information in discussions like this. So just jumping quickly, and I know we only have so much time, it's a challenge because you might be tempted to just rely on a block explorer, and they're great. They do a terrific job in many cases, but there are specific challenges around that. For instance, often there's disclaimers in the block explorer about like, hey, we're not promising everything here is complete and inaccurate, right? So you're like, oh no, well, we kind of need it to be, right? Or the information the explorer provides you access to might not span the entire period that you need information for. What happened 3 years ago, right? Or what was the balance on this blockchain then? Is that available? Is it conveniently exported? Understandably, these platforms are publicly available and somewhat limited. And so there are challenges there, but there's great considerations in that practice aid and other places about how to try to document that. Maybe you could do some testing around that data, right? But I would say the best source of information, and I guess this isn't just my view, is to go to the source of truth, as we say in the space, right? The relevant blockchain. No, you just can't get any closer to the truth about what happened on the blockchain than that, right? Well, how do you do that? Should you run your own node? Sometimes these are inexpensive. Sometimes these are quite costly. Sometimes these can take forever to sync if you don't already have one up and running, right? And so what you need to do if you're doing that is you just need to make sure that your node is in consensus with the rest of the network, right? It does no good if you've got a node that's out of consensus or out of date or whatnot, right? So that check is what you need to do to make sure that you have that information. Now, you might not want to run this yourself for the reasons you mentioned because it might be too costly. There are node as a service providers, right, that will do this for you probably more conveniently, lower cost, things like that. That's fine. You can certainly use them. But again, one thing that you want to check is that the information you're getting is complete and accurate. Well, how do you do that? Well, one way is that if they're just providing you direct access to their node, then you can check yourself whether that node is actually in consensus with the network, right? And so if it is, great. Then you're as close as anyone could ever be to that information. Now, it is worth saying that if you're using a third party to get node information and you're not interacting directly with the node, instead, they have extracted all of the relevant blockchain data. They've indexed it, right? And they provide it in a very conveniently accessible, database. That's convenient. But now the question is, how do you know, right, the transfer of information from the node to that new database is it didn't miss something or didn't make something incorrect. So that's something that they can do as a service provider to either offer a SOC report. They can specifically speak to that. If they don't, then you need to do some testing, right? You need to test yourself whether this information can be relied upon. That testing can come in a bunch of forms, sample tests, things like that, but definitely some important considerations. But again, to summarize, you've got block explorers, which are very convenient to get access to, but probably have the most questions around, can I rely on this information, right? Often you might triangulate information from several blockchain stores at the same time, if they're available, as evidence that you're actually getting to, reliable information. Two is you use a node vendor to get access to that. And then three, of course, is you run the node yourself, which can be a process. So hopefully that canvases some of this stuff. But you let me know. I know there was a lot in there you were interested in.
I think you covered and summarized it at the end pretty well. A follow-up question was, sometimes we have these new blockchains coming up all the time. I want to ask you, how would an auditor go about for a more exotic blockchain? But I believe the answer is it's the same. Either they choose to host the node in-house themselves, or they find these third-party providers, companies like Alchemy, Kaiko, that's like services they provide. Yeah, so I think we've touched on that.
Before we continue, we'll take a quick commercial break from our sponsor. Working in Web3 can transform your career, be financially rewarding, and surround you with a vibrant community. But as you're very much aware, this space requires rethinking a lot of the old models of how we work. For example, as the leader in a Web3 organization, it's up to you to figure out the most cost-effective way to off-ramp the company's crypto, or what's the most efficient setup to mass pay your contractors in crypto. Getting your organization to run on crypto is daunting if you're alone. That's why Request Finance, the industry leader in crypto invoicing, payroll, and expenses, has curated a community of Web3 CFOs to share best practices around Web3 financial operations. With CFOs from leading projects like Aave, The Sandbox, Binance, Consensus, and many more, joining this community will allow you to network and fast-track getting your organization compliant in crypto. And you know what? I'm also responsible for accepting new members and growing the Web3 CFO Club. So if you're a Web3 business founder, CEO, CFO, or in charge of financial operations, you can join this exclusive community today by filling up an application form at theaccountantquits.com/Web3CFO. Subject to a screening check, you will then start interacting with high-profile Web3 CFOs, get access to members-only benefits like webinars, resources, and invitations to physical meetups. Join the club today, and let's win Web3 financial operations together.
Next, I'd like to speak about SOC reports. Finally, the important topic of SOC reports.
Yeah.
So at the client acceptance stage, you guys will have to understand whether the entity, your client, is using a service organization and whether they've obtained like these SOC reports. So as a refresher for the listeners, SOC stands for System and Organizations Controls Report. And let's say briefly, they provide assurance over the IT controls at that service organization. For our discussion today, I want to focus on SOC reports from these custodians that we mentioned before, or exchanges, and the subledgers. So starting with the latter, the subledgers, I'm currently compiling a library of Web3 accounting and finance tools. Currently, I've counted 14 subledgers, so it is a very competitive industry. And I've noted most of them, they have a SOC 2 type 2 report. So I want to ask you, what information will the auditors typically be verifying for that crypto subledger? And maybe what happens if the subledger does not have this SOC report? How will that then affect your audit?
Oh, yeah. Well, my favorite topics. And it might sound like I'm being sarcastic, but no, it is some of my favorites because solving this, right, being able to, operate in this environment in a way that your financial reporting is properly done and your auditors obviously approves of that, then just unlocks so much. And having your assets either at a third party custodian, like you mentioned, or relying on others to just help you get that blockchain data relevant to your activity. And of course, pricing data and other things like that relevant to both accounting and tax. That's what the subledgers, as we've described them, they go by many different descriptions, have done. It's a delight for me to see, there be quite a few of them now. Obviously, there's, like you said, competition, just like there are in accounting firms. But yeah, let's start with them. Stock reports enable companies to have confidence that the vendor or service provider they're using is well run, well controlled, depending on the type of report, is providing them with information relevant to financial reporting that's accurate and complete. And so you mentioned, SOC 1 and SOC 2. And usually you do see both the custodians and the subledgers getting a SOC 2 first. It just controls for a lot of things, a lot of the trust principles that you might think, like data integrity, things like that. Auditors, though happy that clients are using a vendor that has a SOC 2 type 2, even better, right? It means that both the controls are designed properly and operating effectively over the period. That's not the type of SOC they need, right? Alone, right? Really what they're looking for is a SOC 1, right? Type 2, same sort of thing, right? You get both design and operating effectiveness. But the SOC 1 was basically designed for auditors of clients, right? And here's how it works. An auditor has a client and they're looking at their financial reporting. Well, to the extent the client is relying on this third party, in this case, we're talking about subledgers, for data, information relevant to financial reporting, how do you know that information can be relied upon, right? Well, the SOC 1 is designed exactly for that. It is a report over the controls of data relevant for financial reporting for their users. That's what it is, right? And it's like that's what auditors need. And it's tough to get a good SOC 1 type 2 that has a scope that covers everything your clients and their auditors need. It takes time. These reports, they usually have to mature in an industry. Don't blame certainly startups in this space for not having SOC reports that you see at large global banks, right, that have been working on these things for a long time. They start and the scope expands. I will quickly say, though, that for subledgers in particular, for the SOC that you want, which is SOC 1 type 2, the type of control you're looking for from that audit side and management for that purpose is going to be reconciliation controls between the books, the records, and the blockchain themselves, right? That's what you're looking for. So if you ever do get a SOC 1, you hope it's a type 2, you hope it's got a clean opinion, because sometimes some controls fail, right? Scroll down and look for, and these are restricted use reports, so not everyone has access to them, but scroll down and look for those reconciliation controls between the information being provided to your client and the blockchains themselves. That's what you need.
So if you've obtained, let's say just a SOC 2 type 1 report, you would still have to perform maybe additional testing, because right now you've not obtained assurance whether these controls are effective, right? You just obtain assurance they've been designed, they've been implemented, but they're not really operating effectively.
Thank you for the follow-up, because I remember now that you were saying that. What do you do? So what do you just, if they don't have a great SOC 1 type 2, you're just, stuck? No, there are other things you can do, right? Even if you were to take a controls reliance approach, this is from an audit perspective. I'm going to rely on controls. I'm not going to do all that substantive testing. You're still required to do some substantive testing, right? It's not like you could just ignore that, right? But you could certainly get efficiencies by relying on controls. So if you can't rely on controls, either on the management side, that is the audit client side, the company in this space, or rely on related controls that are covered by a SOC, well, then you're back to substantive testing, right? That's where we all started in this space. We're all very familiar with that. It's not necessarily the cheapest approach because it's a lot of testing. What does substantive testing mean? It just means you are directly testing the either balances or the transactions or the other relevant information relevant for financial reporting. And you'll be doing that anyway to some extent, but it just means you'll be doing more of it. So the SOCs can really provide efficiencies. They can, on the subledgers, they can save costs from their users and their users' auditors, but that's the approach. You just switch to more substantive testing.
Sometimes these Web3 startups, David, they are innovating a lot, right? And they are, let's say, neglecting, let's say, the back office bookkeeping. So they've not really maintained appropriate records for their transactions. They've not implemented all these processes and controls we've been speaking about. And they're expecting the auditor to come in and help them a bit, right? So there is a new service called audit readiness for digital assets, whereby the auditor would come to help the entity set up those appropriate controls. For example, let's say having a wallet management policy. I want to ask you if you could walk us through such a scenario. Let's say there's a new client engagement, and the questions you would typically ask that client which would help you to arrive at the conclusion that they need to be engaged first for this audit readiness service, and then later we'll tackle external audit.
Mm-hmm. Good point on audit readiness as distinct from the audit. And some of the subledgers, like you said, have begun wonderfully to roll out functionality, other helpful guidance or industry practices around how you get even ready for your audit. And even if you have an audit and a relevant auditor, how do you continue to improve that, right? So audit readiness is a massive part of this industry. We ourselves offer it, other accounting firms offer it, because often if a client comes to you and says, hey, found out I need an audit. Yes. Like, okay, can I get one? Well, they're just often not ready for that yet. What does it mean to be ready for an audit? Well, that's the things you were talking about, right? Having management have a function specifically around financial reporting. So you have the finance function, you have accounting support, you have people that look at tax and all the rest, right? So that needs to be in place. You have to have people that actually know what they're doing, that are going to work with the auditor to make that happen. You have to have processes, policies, right? It's quite a lot. Certainly, if you have your ambitions to go public in various jurisdictions. Yeah, there was something you mentioned that I'll just throw a little clarification on. What you said, well, sometimes, and I might have gotten this a little wrong, but you said sometimes the auditors can offer audit readiness services. The same company that is in some instances an auditor can alternatively offer audit readiness services, right? But depending on the nature of the audit readiness help, it might be a conflict of interest. They might not be sufficiently independent to then at the same time or shortly thereafter be the auditor. So you have to, of course, always track that. Audit readiness looks like the following. You come in, you do a review, you do a sort of diagnostic. You jump on the phone and you meet with all the relevant stakeholders of the company and you find out, what are your operations? What are your processes? Do you have any controls? Let's just walk through all that stuff and get a sense for what it is. And then, of course, the firm that's offering the audit readiness has the target in mind. They know what auditors are going to be looking for. And so then they'll say, all right, here's where we are. You're here. This is where you need to be on all these areas. Here's, these are gaps you need to close. So then at that point, the company can say, great, you're hired. Can you fix all this stuff? Well, the answer is yes, sure. But I can't also be your auditor at the same time, right? Because especially if that remediation involves work that are designing processes that feed directly into financial reporting, right? Can't do that. But the company could go out and hire someone else and then close those gaps. They could even hire a company, and perhaps after a sufficient amount of time, other auditors have come in. Then later, the one that offered the readiness would be sufficiently clear to then offer. You always have to evaluate these and work with your independence people. That's basically the readiness solution. Companies, if they aren't ready for an audit or certainly aren't ready for an audit at the public company level, that's okay. You can get there, right? And so you can gauge these services to help you do so.
So you mentioned the independence thread there. Let's say like the company, they've been just initiating transactions, let's say from a wallet, but nothing has been documented, right? You would not really help them to come up with these processes and policies in place. If you are helping them, then I guess then there would be a self-review thread and it would have to be another auditor. But if you're just advising them and they themselves have to implement these policies, then I think it's okay.
Yeah. So what part of this is still independent and what part is not independent? And the answer is you can do a permissible audit readiness initial review where the auditor or potential auditor, right, is going to just observe. They're not designing anything. They're just saying like, okay, you let me know how things work, just as an auditor would. Hey, I need to know how you operate, right? And then they'll say, by the way, that's not sufficient. Like what you're doing there, not going to cut it. Now, what you need, the bar is over here. And so here's the gap. So it can be a permissible service that is consistent with independence of the client. To offer that, it's if you were to tell them specifically, like, and by the way, you design this differently, you got to do that thing, and here I'll help you do it.
Now, EY has been at the forefront of blockchain innovation for many years. You guys have partnered with Polygon for the development of new tools. You guys organized the Global Blockchain Summit. I mentioned you've audited renowned public companies like Robinhood, Block, Bakkt. I want to ask you if you could walk us through some of the digital asset services provided by EY US, because that's where you're based, and the internal tooling you've developed specifically for crypto.
Sure, happy to. Thank you for the accolades. Hard won over many years. I do sit in the US, but it might be helpful to learn that I've also recently taken on some of the global coordination on the same topics: blockchain assurance, audits, extended assurance, SOC reports, things like that. So I do stay very well connected to my colleagues around the world. But I would say that when you think about services generally to the space, what are firms able to offer and what are we able to offer? There's audits, which we've spoken of quite a bit. There's related SOC reports, right, that you can come to us on, both on the readiness side and on the actual execution of that engagement, right? There's tax services, right, that you think, oh, of course, yeah, accounting firms are going to offer that sort of thing. But then you've got just a bewildering variety of other services that we do a lot of. Consulting captures a lot of that. Now, consulting comes in many forms, right? Consulting on what? Strategy, or are you talking about just how to improve a process, or we're looking at sort of compliance considerations? How about whether or not maybe you have retail customers and you need a robust AML KYC program, as they say? These are areas that we can help clients with. I think diligence, right? Kind of sounds familiar to audits, but that's where in M&A activity, where there's going to be a transaction, and often EY will be engaged to offer either buy-side or sell-side services. That is, buy-side services would be diligence of the target. These are always interesting engagements because they look very familiar to an audit, but they're much faster paced and targeted for the needs of that transaction. So I think those are some of the main areas. I'm sure I'm forgetting a few, but the goal here is that this ecosystem, the digital asset ecosystem, which now is not just in what we call the crypto natives or some former startups for now, that all they do is operate digital assets, but also in the traditional side, there's a lot of needs. And it's good to be able to offer needs to enable this ecosystem to grow responsibly, right? In the right way and mature as any industry would. So it's been a lot of fun to help develop these.
And because you do audit Robinhood, I want to touch on the proof of reserve that became even more popular after the FTX meltdown. So for listeners who are not really familiar with what a proof of reserve even means, could you quickly explain to us what that means?
Well, I can try. I only joke at the beginning just because proof of reserves, as the expression has been used, is not born out of the audit field or profession or traditional frameworks. It's certainly something that has developed. You might even say it's a bit of a misnomer. Typically, when you look at firms that offer reports to investors or other stakeholders around financial reporting, or whether their customer deposits exist, or controlled, things like this, it's usually not a proof. They're usually you obtain sufficient, appropriate, reasonable assurance that these things are the case, right? And then reserves is a term that's been borrowed from banks in a certain way. But when you think about cryptocurrency exchanges or others that hold customer deposits, they don't do so on a reserve, like a fractional reserve basis. They have to have all of those assets, right? And so I'll just point out a few clarifications in that expression. I would say that on proof of reserves specifically, as that expression is used, I think that it evolved in the absence of exchanges and others that even had a traditional financial statement audit. So if you had that, and that was widely known, then a financial statement audit does the sort of procedures that the market has come to expect from a proof of reserves report. Namely, they actually perform procedures to get confidence that the client's assets that they report, both for themselves and their customers, exist and are controlled and are properly valued. So these are things that a financial statement audit does. Not only that, but the audit has a much more comprehensive evaluation of what the company's doing. What about contracts they've engaged in that might have pledged assets as collateral for something else, right? Like you wouldn't necessarily review that if you were looking at one of these sort of like, proofs of reserve reports necessarily. Now, the institutions that have been offering these reports, they certainly know, and they're sharing that. But I would say there is a big difference between a financial statement audit, certainly one that's at the level of public company that relies on controls, and these more nuanced proof of reserve reports. I will say that they could be helpfully added to a foundation of financial statement audit and an examination of the relevant internal controls. If you had that in place, and then you had a more low latency, report that reviewed customer deposits and whether those were correctly, controlled for and stated, that could be helpful.
Yeah, very clear. Now, I also want to ask you at EY whether you've noted some real world blockchain use cases that EY has been helping its client with that you find were interesting that you could share, of course.
Yeah, real world use cases, blockchains in general. Well, I like to think that digital assets are part of the wide real world. And so these are all very real to me, but I know what you mean. Real in the sense that, sometimes it's said RWAs, real world assets. And
Yeah.
how do we get blockchains to connect with information and track activity of things that are outside the blockchain? So I'd like to say that this is certainly a vision that EY has long had in trying to make this possible. Blockchains are great, and tracking blockchain data, yes, but could these virtues of reliable information, certainly historically, be used to track things outside of the blockchain? And there have been many efforts in many cases. Well, pick one, stablecoins, right? They're tracking things outside the blockchain, right? So you have tokens that are supposed to be pegged to or backed by, in some cases, assets like fiat. Perhaps it's gold, perhaps it's other things, right, that do that. And there's been real robust progress around making sure that they track this accurately, right, and completely and are controlled for. So, for instance, the AICPA recently released this year a sort of framework for the criteria that could be used for attestations of tokens that are backed by things, outside the blockchain. Obviously, fiat was most in mind. But if listeners hear your question, they might think, well, could you get the blockchain to track cars or people or things in a supply chain, right? That would be great. It's just that it's nice to pause and take a moment to appreciate the success that we've had for one use case, which is just tracking, right, things that are pegged to the value of fiat.
Perfect. There's another topic which is close to my heart, which is how to upskill auditors, accountants in general for crypto. I alluded to that knowledge gap in the beginning of our conversation today. So for auditors who want to start offering like digital asset services, I've been speaking with auditors who are looking at the technology, who sees the potential, but unfortunately they don't have the necessary expertise in-house. Some of them, what they do is they would partner with larger audit firms that do have the expertise. They would outsource, let's say, the testing for the digital assets, and they would do the remaining. For the digital assets, there would be regular meetings whereby the digital assets auditor, let's say, they would explain what they've done. And I believe with time, then they can fully take on that engagement themselves, right? When they've learned how to do it. Where would you say accountants, auditors in general, who are curious, let's say, about digital assets, where should they start to learn?
Great question, because the space really needs auditors that are able to properly offer these services, not just in the US, but elsewhere. If you look at certain, jurisdictions, and they would like to provide a sort of regulatory framework that accommodates the specific needs of companies that operate in the crypto Web3 digital asset space. Often in those regulations, they will say, oh, and you also need a financial statement audit. Oh, you also need to get a report from an independent accountant over the effective operation of your internal controls, things like that, right? Well, that's great so long as there are auditors that exist that will do this stuff, right? Fortunately, the answer is there's no dearth of auditors that serve this space. Not only at the big four levels, certainly we have for many years, but also at regional firms, a number of shops. So there are lots of auditors out there. And every now and then I will hear like, oh, they're, auditors can't audit digital assets or crypto. Not the case. It's not the case at all. But now, if you are an accounting firm and you have an audit practice and you have a need or you have an interest in serving clients in this space, just like you were saying, there are very specific considerations and capabilities that you need to have, right, to do that well. And so now, and I don't want to sound like a broken record since I've mentioned it a few other times, but as one example, Canada had a great series. I think it was, what was it, Canada CPA and others that shared publicly both accounting and audit considerations around serving this space. So that was a good initial effort that I saw around the world. Very recently, the AICPA has released an updated version of that practice aid around digital assets I was speaking of, both accounting and auditing. Now, this isn't for every possible accounting jurisdiction in the world, right? But the practices that are included in there are just terrific. They will go down and talk about considerations around how do you evaluate the reliability of the data that comes from the blockchains that you might find yourself in need of because it's relevant to financial reporting. That's great material. It will discuss some of these internal controls considerations. It will discuss both the prevent and the tech side that you need to have. Just good stuff. So I would say that's the first free public place you can go to just see what considerations the auditor should have in mind. But the industry tries to help. I'm always happy to take a call, speak very generally around these topics because we do need auditors to serve this role if these companies are going to thrive in the space.
Perfect, thanks. And you're right, the AICPA guide helped me a lot to understand like the different facets of, let's say, auditing digital assets, and they regularly update it. So the listeners, you should check it out on the AICPA website. David, I'm looking at the time. Time has passed fast. I want to be respectful of your time. So the theme of the episode today was internal controls for digital assets. So I want to ask you as closing thoughts, has there been something that maybe we have not touched on that you would like to share with the listeners, or how would you summarize the episode of today?
Well, I think we've covered quite a bit of ground, just really helpful in getting the message out there. I would say that if the focus of this discussion is on anything, it's nice to consider internal controls. And there's three things that I think we've hit on pretty well, but are worth emphasizing. One is that not just auditors and not just service providers and vendors, but the management of companies themselves really needs to think about reconciliations between their books and records and the blockchains and relevant sort of smart contract data itself. Don't you want to be confident that like things are accurately represented? Another thing, if you're self-custodying your own assets, just make sure you've got access to private keys, right? You might have had it at one time, but later perhaps not, right? So these things need to be carefully monitored. So you think about controls related to that. And then finally, and we've hit on this pretty strong, which is now there's quite a variety of service providers, both on the accounting and tax side, the subledger solutions, and then also on the custody side. Great. By all means, use them, but make sure that you perform some vendor due diligence. Make sure that you had that counterparty risk management process in place so that you can rely on them in a way that your auditors and others need you to. So I would say those are three big areas to hit pretty importantly.
Perfect. Thanks for sharing, David. There's a last question which I like to ask my guests before they leave on this podcast. It's like a tradition. Do you have any personal quote or, let's say, a maxim that you live by?
Oh, I definitely should have prepped for this one. No, I don't. But I would say that I think success in this industry is going to rely on us all working together to figure this out. And that's one of the reasons why I so enjoy working in this digital asset, cryptocurrency, Web3 environment, is because it reflects an ethos that I've always had of trying to build consensus and trying to engage the community to develop public goods that will make all of our processes and activities better. I know that wasn't a pithy expression, but definitely one that I see in the community, and I also hope that we can also all reflect.
Perfect. Well, thanks a lot for coming today. I've learned a lot preparing this episode. I'm sure the listeners have as well. If, let's say, people want to reach out to you, I know you're a public figure, you are speaking regularly at events, conferences. If people want to maybe meet you in person at some of the upcoming conferences that you'll be at, how should they reach out to you, let's say on socials?
Oh, absolutely. You can find me just about everywhere. I've doxed myself, right? That is one distinction that I have with some members of the community. You can always reach me by my email, which is simply david.byrd@ey.com with a Y, right? It's that spelling. And yeah, you'll find me on LinkedIn. And I'm always happy to share Telegram and other handles, so you can get in touch with me all sorts of ways.
Perfect. Well, thanks a lot for your time today, David, and we'll be in touch.
Great. Thank you. Really appreciate it.
I would like to thank everyone for listening to this episode. You will find all the links of the episode, show notes, and transcript on the website of The Accountant Quits at theaccountantquits.com. Please note that this content is for general information purposes only and is not a substitute for consultation with professional advisors. If you do know anyone who could benefit from the episode and you care about them, please do share the episode with them. All the episodes are available on Spotify, Apple Podcasts, and Google Podcasts. And by leaving us a review and rating, you will support the channel and all your fellow accountants. In order to be notified each time we release a new episode, do follow us on Instagram and LinkedIn. We hope to have you with us next time. Bye for now.